Joining me now, Post 9, Kristin Olson, Global Head of Alternatives for Wealth at Goldman Sachs. Welcome. It's good to see you.
Thanks for having me, Scott.
You know, to talk about alts has really picked up because the money flow there has been unbelievable. What do you see?
Yeah, look, I would say our clients in wealth are incredibly excited about putting money to work in alternatives. I'd say they remain very much risk on, and we're seeing a lot of flows into the space.
I'm surprised that it doesn't look like it's slowing down even a bit. If you look at, you know, the folks that I've talked to, and you say, well, what does the runway look like? You know, different interest rate environment, maybe, you know, there are more macro challenges around, and nope, we're in like the third inning of this. Is that what you're seeing too?
Yeah, look, I think the beauty is with alternative investments, you sort of have to put the blinders on. Similar to what we say in equities, stay the course, very much true of alternatives. It's a long-term investment horizon. So our counsel to clients is you have to be committing to this asset class year in and year out, irrespective of what's happening in the macro environment.
Good debate over what a portfolio should look like in the years ahead. 60-40 obviously has been traditional. 50-30-20, 60-20-20. How are you thinking about portfolio construction in this brave new world of alternatives?
Yeah, I mean, I would say our North Star for our wealth investors is to get a moderate risk client to almost 25% of their portfolio in alternatives.
Oh, so a quarter.
That's a big number, and that's for a moderate risk client. But we're on a journey because it takes a long time to get to that number. Now, that number is going to be lower for a high net worth client or a retail client, but we have big aspirations for where we'd like our clients to be positioned.
How tough of a sell is it for some of your moderate risk clients on the asset class itself? Trying to educate them. We're just out at the CASE conference out in California, and the word I heard more than anything other than alternatives was education, how the institutions and the asset managers are trying to educate clients on the kind of risk-adjusted returns that you can get from alternatives.
So I would say for our clients, which are certainly ultra high net worth, it is not a difficult conversation. And part of that is because they've been investing in alternatives for a long time, and they've seen the outperformance that it has generated in their portfolios over long time horizons, over 5, 10, and 15 years. And so they recognize that alpha that exists in alternatives. But as we think about opening the aperture to broader groups of individual clients, education is definitely the key as we try to explain to them what are the trade-offs, right? Obviously, people understand the outperformance and the return, but how do they think about the illiquidity risk that's going to be inherent in their portfolio by investing in alternatives?
Speaking of returns, I mean, obviously, you know, a huge part of alternatives is private equity. Exits, realizations have been slow, to say the least. I'm curious your outlook, and I want you to listen to what the great investor Todd Bowley told me last week about how he sees the market for deals. Let's listen.
I think we're in the process of having lots of M&A get started. I think we're seeing more and more activity. I think we're seeing people want to transact. People have to kind of get back to, the transaction business. So, across our portfolio, we're seeing lots of kind of merger and consolidation discussions going on. I think some of them are in their earlier days, but I think the animal spirits are coming back and people want to get back to it.
Animal spirits are coming back. I mean, what do you think?
I'd agree with Todd. So,
really?
I think there's a lot of positive factors that are going to contribute to an interesting outlook for private equity over the next 12 to 18 months. So, one, you have rates moderating, which should open up capital markets activity, right? So, one, you can see refinancings, dividend recaps to try to get capital back to investors. You also have a lot of dry powder that these private equity firms are sitting on that they need to put to work. And we're at a moment right now where after 2 years of valuations moderating and private equity multiples coming down, hopefully we seem to reaching an equilibrium level where money will start to get deployed again and transaction volumes will start to pick up.